In this video, I want to go over how I made a little under $10,000 the past 2 days trading the S&P 500. I want to break down each setup, my thought process, my entry, my exits, and I want to go over the psychology backing each trade. Before we get into it, I recommend everybody watching this, if you're not already following me on my Instagram, I will post a link in the description below to do so. It's a really good resource where I post daily trading recaps, along with really good trading tips and tricks that I guarantee you're not going to find anywhere else. Again, the link is in the description below. You're missing out if you're not following it. But now let's get right into this recap. The first trade I want to talk about was on Wednesday, June 7th on the S&P 500. It was a little under $4,700 profit, shorting a supply zone on the ES future contracts. So pulling up this chart, to back this scenario and to understand this a little further, we have to understand the larger time frame picture and what the context is going on and what's the theme of the market. So right off the bat, just looking at the action from the past couple of days, we can see the market has rallied and then we've consolidated, and we are very, what I call, balanced, meaning we are not really finding a direction. We are consolidating and participants are agreeing on price. Now, when the market is this balanced, ideally you want to be shorting the highs and you want to be buying the lows, aka fading the extremes. On top of this very large sell-off on Monday, June 5th, formulated that supply zone, and because of how aggressive that was a 40-point sell-off to the downside. This was a very important supply zone that I was watching. In fact, on the 6th, the day prior to Wednesday, so this is Tuesday, my overnight plan was watching for a rally into 4302 to 4307 supply to play the market short, targeting 4290. Now, every single day in the Discord, I post pre-market plans and commentary updating my thoughts throughout the market of what I'm seeing formulate in real time. The pre-market plan on the 7th, which was Wednesday, was we were watching that 4302 to 4307 supply zone that it's been responsible for selling the market off before, and I'm watching for any strong rally into this level. Be cautious to be a bull, and sellers could step in and sell the market off lower. So the main reason for this trade and a little under $4,700 profit was back in August of 2022. This has been an area where the market has rejected before, and coming back to June 2023, earlier in the week, this supply zone which formed sold the market off very, very aggressively. On top of that, we are balanced where you want to be shorting the highs and buying the lows. So we kind of get all the pieces to the puzzle coming together. Then 24 minutes into the market being open, I post in the intraday commentary tab that I am in the market short at 4303. As soon as we were coming up, I was shorting into the strength, fading the extreme. I was watching buying slowing down, and as long as selling steps in, we're going to see a nice sell-off from that supply zone. My first target was 4290, and then 4272 directly below that. Here's that yellow line, which was 90. Now, what I saw on the tape, which was the cherry on top, it's the confirmation for entering the setup. It gives me my reason why I clicked that sell button at the highs. Well, as the market was rallying, we saw all this aggressive buying. We see tons of at-offer trades, a bunch of at-aggressive market buy orders come up as we're in an area of supply, yet there is no continuation, yet there's no follow-through. So if there's downside selling pressure and at-bid trades, this is going to cause a reversal to the downside. As the buying comes into the market, these buyers must stop out as we come lower. All this aggressive selling steps into the market, and that was my reason for entering the trade short. I'm short when the market looks just like this. My stop loss is above the supply zone. Now, it's not always at the top of a supply zone. However, in this case, I put it at the top of the supply zone because it was only 4 or 5 points away. I'm in the trade short. We get that nice sell-off. I sell some of my position down here, 80% of it at 4294. After we bounce off this 4290 level, very aggressive market selling off of that supply zone, and I keep a couple contracts open in case we want to keep selling off, because I said this has the characteristics to be a very large type of sell-off day if we can get below this 4290. The tape, the conditions, and everything that I've been explaining so far in this video led me to believe that if the selling continues and we get below that key level, there's going to be further selling, and that's why I had in the back of my mind a further sell-off into that 4272 level, which is this green line lower. And then I got all out of that trade around 4277. It was still very weak, but I protected myself. It was a longer type of trade that I'm in. However, it was just lower lows, lower highs, rallies were failing, and I was comfortable after my first scale to hold this position and just simply walk away and put a stop loss and not even manage this position. But excellent setup, finding buying drying up at supply, and shorting once selling starts initiating off of that supply zone, using the downside targets as areas to take profit. Okay, now the day I'm recording this video, June 8th, which was Thursday, same exact scenario. The market still is inside of this balance range. Buy the lows and you sell the highs until there's continuation and until there's initiative action at the high or at the low. There is no initiative action. In fact, there's responsive action that inside of this balance, every single time we break the previous day low, we bounce and rally up higher. That is not a good sign if you're a bear, and that's not a good sign if you expect downside. If we are breaking lows and bouncing every single time we break, that's an idea that the market may reverse higher. So in the overnight session, we sold off, broke below the previous day low, and bounced off this demand zone and began to rally higher. In my pre-market plan today, June 8th, I said the downside is going to be limited above 4266 demand. It's bounced overnight. And then to the upside, we had a small resistance level that if we could get above it, we're going to target the supply zone above. Any downside move lacks continuation. Now, 15 minutes into the market open, I said, let's see if 4269 to 4266 can hold. If it does, and this is very key here, and bids step in, this means passive buyers are patient enough to wait for the market to come lower and they act like a floor to price. If that happens and there's at aggressive offer trades, meaning liquidity is taken from the market to the buy side, I am interested in taking the market long, targeting the pre-market high. 10 minutes later at 9:56, I got long at 4266, targeting 4280, which was the pre-market high. My risk was about 5 or 6 points lower when the market looked just like that. Essentially, what I saw here was the market broke the low. It lacked downside continuation. There were very strong bids which stepped into the market, and despite all this aggressive selling, the market reversed higher. If there's a lot of sellers coming into the market and we can't move lower, that's a good sign that if you're a bear, get out of that trade, cover your position, and that could also start to fuel a further rally higher. So my main analysis for this trade was how the bids stepped in at the low, we lacked downside continuation, and there were a bunch of trapped sellers at these lows, formulating a possible reversal to the upside. As soon as I see this at 9:56, I hit a market order and I get in immediately. So now I'm in long. My stop loss is not below this low. In fact, it's a little lower just to give it a little breathing room in case we break the low again and it lacks continuation. Someone's basically like building up a position. So now I'm in long. This thing looks really, really good. We get a strong push up and we come right into my 4280 target, and I get out some of my position there, 1 point lower than 4280 at 7.9, and then I held a remainder until this level failed, and I got out on this pullback, all out. And this is what's very important here, because I don't look back at this trade and say, oh, I could have made X amount more. I look at it as, did I follow my plan? My plan wasn't to hold this thing all day long. My plan was to hold until my target, and my target was 4280. I said it's still very bullish. I just don't want to hold on a pullback. We bought the low and sold the high. Now, if you go to my pre-market plan, this is very important because I know a lot of people are going to be like, oh, you could have held on to this trade and made 5 times the amount that you did on this. You know, we're sitting here looking at this as a little under $5,000 winner, but this could have been a $15,000, $20,000 winner if I did hold on to it. However, we wouldn't even be saying that right now if the market rejected at 4280 and we sold off lower, and I literally sold at, let's just say, the high. However, if we were to go back to my plan, the bullish scenario was if we can get above this 4285 to 4291 level, which is this pink box, if we find acceptance, if there's strong buying here, then longs are in the picture into that same supply zone that we shorted the day prior to that. Now, if I kept holding, we found acceptance at this supply zone. We're not selling off. We're formulating new demand. and strong market aggressive buying came into the market, and I could have capitalized on another 20 points. And 20 points on 8 contracts is a lot more money that I could have made. So never look at where the market went after the fact. You just got to ask yourself, did you sell at your target? Now, if you review your journal and you see maybe like 9 out of 10 trades, you're selling way too early or your targets are too close, then you need to compensate and adjust to that. But don't let one win that you could have made 5 times the amount affect your future trades. And always remain in the present moment. Never think about the future. Never care about the past. It's over with. Focus on the now in the market, because that's what I did with these 2 trades. And they were really, really good trades, shorting supply and longing off demand, using the tape as confirmation. I'm going to end the video on that note. If you learned something from it, I would really appreciate a like on this video, comment any questions, and definitely check out the links in the description below. The Discord is only available and it's included for Ameritrade course members only. And I've been working very hard on the new order flow videos that I will be adding to the A to Z. They're going to be a complete game changer for the retail trading community. But peace out.